Many people are unaware of the tax advantages of investing in the Australian stock market from abroad as a non-resident. Today, I will discuss 4 reasons why investing in the Australian stock market can be advantageous to you as a non-resident. And a disclaimer, this is just an educational video. Please do not take this as any advice. Number one, access to the Australian economy. We are the lucky country, and while we may not have heard that much in recent years, it is still the case. The Australian economy is built on strong exports of raw materials that are in high demand and are incredibly high quality. While we are reliant on certain raw materials like iron ore, which in 2021 was 33% of Australian exports, we have to understand that the quality of iron ore we have in Australia is unlike anywhere else, and there are few competitors to us. That being said, with strong regulation in Australia and consistent historical growth, I see the Australian stock market going to strength in future years. Number two, no capital gains. If you buy and sell Australian shares as a non-resident in Australia, there is no tax on that one. Therefore, you're in an advantage position where you don't need to declare any of this. One reason why it's like this is the Australian government encourages foreign investment in Australian shares. And one way they do that is by ensuring that no capital gains tax is paid on any of those disposals. Number three, no further tax on franked dividends. If you are holding Australian shares that pay out franked dividends, there is no need to declare that in your Australian tax return, and there is no need to pay any further tax on that one. If you are an Australian taxpayer receiving a dividend as a high income earner, you need to pay a top-up tax from that franking credit. However, as a non-resident, there is no need to pay any further tax. If the shares you hold pay unfranked dividends, then there may be withholding tax of between 15 to 30% based on the country that you're a tax resident of. And number four, manage potential currency risks. If you're investing in Australia, it allows you to keep assets valued in AUD. Because that being said, you may be earning income in USD, pounds, dirhams, euros, or something else. By facilitating your investments within AUD, it allows your spread of currency to be a bit more diversified, thus not exposing you to whatever may occur in your country where you're earning your income. If you want to learn more about Australian tax on investments and the consequences of it, please do not hesitate to reach out, as I work with many people in this scenario. And if you want to learn more about the exit tax from Australia and the potential deemed acquisition on the shares on recommencing Australian tax residency, I highly recommend watching this video here. Thank you.